How exactly do companies allow you to trade stocks for free? If you've been following the story of Robinhood, the company that really pioneered the idea of trading stocks for free on an app on your phone, then you might have heard of what's called payment for order flow. In a nutshell, this is when a brokerage, where you place your stock order at, gets a payment from another firm to send your order there for execution instead of sending it to a stock exchange. And of course, if they are paying for the ability to execute your trade, there must be an incentive for doing so, right? And this process, payment for order flow, has been getting a lot of scrutiny. After all, payment for order flow was pioneered by Bernie Madoff. We're going to dive into this and answer some of these questions. How can stock trading commissions be free? What is payment for order flow? How does it work? Is it legal? Is it bad? And more. Hey everyone, my name is Preet, and this channel is for anyone who wants to learn more about personal finance, investing, and the world of money around us. Let's start with a brief history of trading commissions. As we've seen time and time again, technology and competition have helped drive down costs in many areas of our life, and stock trading commissions are no exception. If we go way back in time, you might be surprised to learn that stock trading commissions used to be fixed and highly regulated. An important date in the securities industry was May 1st, 1975, known as May Day in the industry, as this is when all stock commissions were fully deregulated and brokerages were allowed to compete on price. Now, it actually took a while for prices to come down. In fact, they actually went up for small investors in the few years after May Day. Looking at this New York Times article from 1978, we see that Merrill Lynch actually increased commissions by 7 to 8%, which led competitors to follow suit. The article gives an example of a commission for buying or selling 100 shares of a $30 stock, so a total trade value of $3,000. Before May Day, the commission would have been $43.50. But 3 years later, in 1978, it was actually more, $48.50. The commission, as a percentage of the trade value, was 1.6%. But perhaps the more striking part of this commission amount was that it was in 1978 dollars. If we adjust for inflation, that trade would cost $204.05 in today's dollars. But it's important to keep in mind that discount brokerage commissions differ from what are called full-service brokerage commissions. A full-service broker is basically when you use a dedicated investment advisor. They have access to their firm's research on the stock that you're trading, and they're supposed to provide advice and other bells and whistles. A discount brokerage is synonymous with executing trades yourself, with no frills, so to speak. You're basically on your own. And these deep discount brokerages weren't very prevalent back then. If we look at this article in the New York Times from 1990, we see a comparison between a full-service broker commission and a deep discount brokerage commission for a larger trade of 1,000 shares of a $10 stock back in 1983. So this is $10,000 versus the $3,000 in the previous example, but the full-service brokerage commission on this trade value of $10,000 would have been $240. Again, adjusting for inflation, that would be $660.99 today. And the no-frills discount brokerage commission would have been $64 or $176.26 in today's dollars. So we're talking 2.4% of the trade value for the full-service broker and 0.64% for the discount brokerage. Fast forward to the late 1990s, and online trading at discount brokerages started seeing flat rates of $29.95 per trade. And that's if you were placing your trade online, which was a novelty back then. But if you called in, the same firm would charge you $144. At $29.95 a trade on a $10,000 trade, that's just under 0.3%. And today, at $9.95 a trade on a $10,000 trade, that's less than 0.1%. And of course, a no commission would be free. Or is it? Well, it turns out it depends. In the United States, commission-free trading may indeed be mostly free, But in Canada, commission-free trading may actually be more expensive than paying commissions, at least if you're trading US-listed stocks, and I'll come back to that in a minute. To understand how commission-free trading is possible in the US, we need to understand this concept of payment for order flow. Payment for order flow is allowed in the US, but it is not allowed in the UK, Canada, or Australia, and I think a number of other countries. So what is payment for order flow? In order to really understand it, we first need to understand the other major cost of trading stocks. This other cost is known as the bid-ask spread. So what is that? Well, if you look at a typical stock quote, you'll always see the bid price and the ask price. The bid price is the highest price someone is willing to pay to buy the stock for, and the ask price is the lowest price someone is willing to sell the stock for at one particular moment in time. The bid and the ask are generally slightly different numbers, at least for stocks that are heavily traded. For example, looking at Tesla stock, we see that at this particular moment, the bid price is $1,234.73, and the ask price is $1,235.21. This is a difference of 48 cents. This is known as the spread, hence bid-ask spread, or just the spread for short. As a percentage of the stock price, this spread is pretty tight at 0.04%. The spread can be larger for less liquid stocks. For example, let's look at a lesser-known stock, Optibase, which I know nothing about. Here we see the bid is $10.50 and the ask is $11.69. So the spread is therefore $1.19. As a percentage of the stock price, this spread is over 10%, which is massive. Now, what you might normally think happens is that you place an order at your brokerage, it gets sent to a stock exchange where the exchange facilitates the matching and execution of trades with other investors who have placed orders at their brokers who have sent their orders to the exchange as well. The exchange charges your brokerage a small fee. For example, it might be fractions of a penny per share, and the commission your brokerage charges you is more than enough to cover that. And that is what happens a lot of the time, but not all of the time. In the early 1980s, this all started to change because of some regulatory rule changes that had been recently instituted that are somewhat technical, but the take-home message is that these rule changes, along with technological advancements, meant that real-time quotes and reporting of trades within 90 seconds basically allowed everyone to see more clearly what all the bids and asks were for any stock listed on the New York Stock Exchange. Why is this important? For competition with the New York Stock Exchange. Now, other market participants could guarantee to their clients that they could execute trades at prices that were as good as what's called the National Best Bid and Offer Prices, NBBO, meaning that the cost of not getting the best price could be established and avoided by other market participants, and this opened up a lot of competition. According to Senate testimony in 2014 by Robert Battaglio, who is an expert in order flow inducements, market structure, and trade executions, he said that in the early 80s, market makers started to offer retail brokers 1 to 2 cents per share in exchange for routing their order flow to the market makers instead of the exchanges. This is payment for order flow. But these market makers could instantly execute the trades at the national best bid and offer prices. And at this time, if a retail broker sent the order to the New York Stock Exchange, the exchange would charge them 3 cents per share upon execution, and it might take longer to find someone else on the other side of that trade, especially if you're placing what are called odd lot orders. So one of the functions of market makers is to increase the speed at which executions can take place and provide liquidity to the market. And this all sounds great. Fast forward to today, and market makers pay a lot of money to brokers to send their orders to these market makers. And these market makers can often execute at prices that are better, slightly, but better than the national best bid and offer prices. And again, this all sounds like good things, right? As a conceptual example, imagine we have buyers on one side and sellers of the same stock on the other side of a trade. And let's say that the best bid is $49.95 per share, and that the best ask or offer is $50.05 per share. That's a spread of 10 cents. If a market maker wanted to offer to buy shares for $49.96 and sell them for $50.04, on average, they might earn an 8-cent spread. They could give part of this spread, call it 2 cents per share, to the brokers for a total of 4 cents, 2 cents on each side of the trade, and still earn 4 cents. And if you think about all parties involved, they are all better off. Someone placing a market order to buy gets filled at $50.04, not $50.05, so it's 1 penny cheaper. Someone placing a market order to sell gets filled at $49.96, 1 penny better than $49.95. The broker gets the payment for the order flow, and the market maker makes money too. Now, firms are required to report how much price improvement selling order flow generates, and in 2020, the net price improvement for retail investor execution was $3.6 billion. That's a big number. This is the sum total of how much lower retail investors were able to buy shares of stock versus the national best bid prices quoted, as well as how much higher they were able to sell shares for compared to the national best offer prices, all because of payment for order flow. And when you think about it, the broker was used to incurring a cost to get a trade executed for a client if they placed the order on a traditional exchange. But by placing it with the market maker, they earned revenue. And this is one major reason that has allowed no commission trading to become a thing. Now, very quickly, there are other revenue sources for brokerages to keep in mind. Something called net interest margin, fees for enhanced services, and currency conversion fees. Net interest margin is a big one. Brokerage clients often have quite a bit of cash sitting around in their accounts earning basically nothing. And when you add it up across all clients at a brokerage, it can be a lot of cash always just sitting around. If the average brokerage client has 10% of their portfolio in cash, then across all the clients at a brokerage, you might have billions of dollars of cash. And they don't just let it sit idle. They make money on the spread between what they pay in interest on that cash versus what they can lend it out at. If we take a look at E-Trade's 2019 financial statements, they had an interest spread of 318 basis points, which means the difference between what they earned lending this money out versus paying interest to clients holding cash in their accounts averaged 3.18%. How much cash were they sitting on? $58.2 billion. Multiply that by 3.18%, and you get $1.85 billion. I had to double check that, and yep, $1.85 billion in revenue, largely from idle cash. That represented 64% of their total revenues, far greater than the commissions they charged, and much more than the payment for order flow that they received as well. So even though payment for order flow is banned in certain countries like Canada, there are still some brokerages in Canada that offer commission-free trading. So how can they afford to do this? Well, net interest margin can be big, and in particular for Canada, if your clients are trading US stocks, you can charge them a currency conversion fee both ways and effectively earn 3% roughly when someone buys and exits a US listed stock if you force them to always convert currency for each leg of the trade. And at 1.5% per trade, that is actually more expensive than a brokerage that charges an explicit commission but allows you to hold US cash in your account between trades. So yes, commission-free trading can actually be more expensive in terms of costs you bear versus paying a commission, at least in Canada and maybe other countries where payment for order flow is banned. Another source of revenue can be the selling of enhanced services like access to market data. But getting back to the US, where payment for order flow is allowed and is big business, and when done properly can look like a great thing for the industry and investors, why has it been getting a lot of negative press? Well, like I just said, When done properly, selling your customers' order flow to market makers can earn you money and allow for the trades to be executed at the best price. However, Robinhood was fined $65 million to settle charges by the Securities and Exchange Commission, the SEC, for not only failing to get the best prices, but for making misleading statements that it was getting best execution pricing and not disclosing that they were receiving payments for order flow. Robinhood was also fined by FINRA, the Financial Industry Regulatory Authority, to the tune of $57 million, plus in order to pay $12.6 million in restitution to thousands of its customers just a few months ago for a separate matter relating to operating outages and also for approving people to trade options when it was not appropriate to do so. This was the largest financial penalty ever ordered in the history of FINRA. Okay, so here are my final thoughts. Is commission-free trading good? I don't think this is a black and white issue. It's been amazing for financial inclusion. It's made it possible for more people from different socioeconomic backgrounds to become investors, and that is a good thing. In the US, when done the way it is supposed to, it is possible that payment for order flow reduces the cost of placing trades and can improve execution price and provides more liquidity to the market for retail investors, and these are all good things in theory. However, what we've seen is that whereas in other industries, disruption can often include ways to cut out the middle persons in order to bring lower overall costs through technology, we've almost seen the exact opposite when it comes to market structure. The business of being a middle person when it comes to trade execution has only been growing because it's very profitable. Whether it's market makers paying for order flow, high frequency trading firms paying extra for enhanced data from exchanges, or maker-taker models and alternative exchanges, billions upon billions are being made by market execution intermediaries, and that just seems wrong. People much more knowledgeable about market structure than myself have suggested that trade execution should be regulated like a utility, and it's a very compelling argument. But getting back to whether commission-free trading from the investor's perspective is good or bad, by making trading too easy, it leads to too much trading by individuals in their own accounts. In one of the more famous academic papers in finance, written by Brad Barber and Terence O'Dean, titled "Trading is Hazardous to Your Wealth," the authors find that the more you trade, the worse your performance is. If you divide investors into 5 groups based on how often they trade, the group that trades the most, the top quintile, underperformed the group that traded the least by 9.6% per year. Robinhood faced heavy criticism for using exploding confetti graphics on its app whenever a user placed a trade, and as you can imagine, this encourages more trading. They've now replaced the confetti with more muted graphics after this scrutiny. However, let's just look at the astounding difference in behavior of retail investors between Robinhood users and, say, the users of Schwab, which is another brokerage. Reporting in the New York Times said that for Q1 of 2020, Robinhood users traded 40 times as many shares per dollar as Schwab users. 40. But even more shocking, 40, Robinhood users traded 88 times as many options contracts. If we look at Robinhood's most recent earnings report for Q3 of 2021, let's compare the 3 quarters of 2021 versus 2020 to see the change in user behavior based on revenues. While we see their total transaction-based revenues have increased by 135%, revenue from users trading stocks increased from $171 million to $235 million. Now, that's only a 38% increase, but the revenue from options trading increased from $298 million to $526 million. That's a 77% increase. And crypto, it went from just $15 million to $371 million, and that's a 2,402% gain. It is clear as day that Robinhood users are taking a lot of risk, and they've been getting even riskier over time. It seems clear that reducing the barriers to trading encourages short-termism in investing, which really is just speculation or gambling. And that's a bad thing. And we've seen this before, but it works until it doesn't. And when it doesn't, it can be spectacular. There is an undeniable entertainment factor that many people seek when it comes to investing, and it can steer some people towards this very speculative behavior, especially when we are deep in a bull market in pretty much any asset class. Investing has two functions, it seems: capital growth and entertainment. Some just want capital growth, and that's pretty rare. And some just want entertainment, and that's also rare. And many people are somewhere in between these two extremes, and it looks like we are tilting more towards the entertainment factor right now. That will eventually swing back, but probably not until something cataclysmic happens when a lot of people get hurt. So stay safe out there. If you like this video, hit that like button and subscribe to my channel to learn more about money and managing your finances. And of course, hit the bell to turn on notifications for when I publish new content, and I will see you in the next video.